Hi, this is Kyle Boston, Vice President of First Coast Financial Group, and this is your market outlook for the fourth quarter of 2020. There are three big areas of interest for investors heading into this fourth quarter: the presidential election, tech stocks, and interest rates. Historical evidence on presidential elections suggests that they have a much smaller impact on the market than investors think. Looking at the data all the way back to 1860 for a 60-40 moderate portfolio, the average return is 8.9%, and the average return during non-election years is about 8.1%, ultimately showing no statistical difference. Not only are returns not really impacted, but market volatility, or the measure of swings in either direction, really doesn't change during election years. Measuring from 1964, the S&P 500 index's annualized volatility during the 100 days before and after the election show that they come in exactly at 13.8%, which is lower than measuring the entire time period, which measures at 15.7% volatility. Technology stocks have led the rally back from lows earlier this year. Actually, it has really been the largest 5 stocks that have driven this rebound in the S&P 500: Microsoft, Apple, Amazon, Facebook, and Alphabet, formerly known as Google. For the year through September 18th, these stocks have returned about 28%, while the other 495 stocks in the S&P 500 are actually down over 3%. These 5 companies are so large, they actually make up over 20% of the entire S&P 500, a concentration that is higher than at any time during the past 30 years. Return dispersion between segments in the market is also at its highest point in 20 years. But all of this will remedy in time, as mean reversion, or the theory that asset prices and returns will eventually return to long-run average levels, is likely to win out. The Federal Reserve put out its dot plot indicating where members expect interest rates in the coming years. The majority shows no real change in short-term interest rates all the way through 2023. What this means is that the Federal Reserve is trying to communicate to everyone that it is going to maintain ultra-low interest rates for years, essentially below the rate of inflation. Although some pundits point to the PE ratio, say that the market is expensive, the PE should be adjusted for interest rates. The PE ratio is the price to earnings ratio, and it relates to a company's share price to its earnings per share. Typically, a high PE ratio indicates that something is overvalued. In brief, by using a discounted cash flow method and adjusting for the ultra-low level of interest rates, the overall stock market remains to appear reasonably valued and is poised to see higher levels after any short-term corrections run its course. In sum, investors should not get distracted by the election or any ebbs and flows of the top tech stocks. In turn, investors should realize that the ultra-low interest rates will support further market gains. As always, if you have any questions about what was discussed today, or if you're interested in taking a closer look at your risk tolerance in your portfolio, please visit our website at www.firstcoastfinancialgroup.com. If you click the Schedule a Meeting button, you can actually schedule a phone consultation, a virtual meeting, or an in-office appointment directly through there. And as always, you can feel free to give us a call at 904-288-0103. This is Kyle Boston, and thank you very much for tuning into your fourth quarter market outlook.